Ashok Ajmera, the convener of this program, would like to recognize the presence of our partner organizations. I recognize the presence of CA Lalit Bajaj, the Chairman WRC Institute of Chartered Accountants of India, and CA Jayesh Kala, the coordinator from WIRC for this event. Thank you very much for being partnering with us. We also recognize the presence of Shri Harjit Singh Talwar, the District Governor of Rotary International, District 3141, our service partner for this. Thank you, all the gentlemen. Now I request our JPF Director in charge, a handsome chartered accountant and a dashing personality, also engaged in the business of financial services, to give his welcome address and take the proceedings further. Mr. Ravi Jain. Ravi, please take it forward.
Good evening to everyone who are attending this panel discussion on emerging new world order and opportunities for India. I welcome all the office bearer of JITO Apex and JITO Professional Forum, all the distinguished panel of speakers, and our associate partner, Sri Kamal Duggarji from Akhil Bharatiya Tirupati Yuvak Parishad for joining us in this session. Businesses are facing huge challenges due to the COVID-19 situation. At the same time, it has unfolded emerging new world order and opportunities for India. In today's webinar, we will get a chance to know about such opportunities. Now, I would like to invite some of the JITO and JPF dignitaries to express their views. They are true entrepreneurs. They thrive in adversity and get satisfaction from solving the challenges. So now everybody, please welcome the person who revolutionized the education loan business in India, Mr. Ajay Bohra, Vice Chairman, JITO Professional Forum. I would request Mr. Ajay Bohra to give an overview of JPF.
Thank you, Raviji. Just to update you that we have already reached our full house capacity of 1,000, which is again, like a history in its record. We have done it. This is the third time we have done it for the webinars. Good afternoon, everyone. JITO Professional Forum is a vertical of JITO, which consists of the professionals and which gets operated by the professionals. Its members include doctors, lawyers, architects, banking and financial services professionals, CAs, salaried executives, and engineers. Well, when we face these health-triggered economic uncertainties in this interconnected and interdependent environment, the importance of professionals and domain experts gets underscored and highlighted. JITO Professional Forum presents a platform where professionals can connect with the business community at large and create collaborative advantage, which is the key to survive and thrive during these uncertain times. Today, we appeal to all professionals to join JITO Professional Forum to network with fellow professionals for unlearning and relearning. Thank you.
Thank you, Ajay ji. The next person I am going to welcome is highly inspiring. He never gives up. He is a philanthropist. He is that pebble in that pond which creates ripple for change. He is the motivator, humble, visionary, versatile, generous, and he has all the qualities that most of us dream to possess. Please welcome Sri Ganpat Chaudhary ji, JITO President. I request Sri Ganpat ji to enlighten us with his views.
Very good evening, friends, and I'm really very pleased to welcome all of you in the JITO Professional Forum's great seminar of the day today, which is much needed for the country and for all of us business community leaders who are going to listen this great seminar today. I personally, first of all, my heartiest congratulations to entire team of our JPF Professional Forum, mainly Ravi, Bohra ji, Ajay ji Bohra, Ajmera ji, Kotari ji, everyone, those who have taken the efforts to make these things happen today. My very special thanks to Sanjay Dangi. He is a very good and very close friend of me, who has been instrumental in sending all the messages to all the person who can be benefited from this, because he has invited few guests who are directly relating to this subject of today, emerging new world order and opportunities for India. It's a really great opportunity for all of us to get benefit from all the distinguished guests who are having the vast experience of various opportunities and investment in the world around. So thanks those who have done the hard work for getting them on the screen, so that all our members who are there, more than 5,000 people are already participating, and still many people are waiting. I'm sure this is a one webinar who will have the record webinar, whatever we have held till today. And I'm sure the hard work which put up by the JPFT will be in benefit of the JITO. So thank you all the guests who have found the time to come on this webinar on our invitation. I again welcome and my best wishes in advance to all of you, JPM and all the members and distinguished guests. And I'm sure I am also going to listen, and it will be in the benefit of all the people who are participating. Thank you very much, and best of wishes.
Thank you, Ganpatji. Please welcome the capital market veteran, the gold medalist in Chartered Accountancy and a company secretary, Mr. Sanjay Dangi, Chairman-JITO Audit Committee and ex-JITO Apex Director. Sanjay ji will be moderating today's event. I request Sanjay ji to take over the proceedings.
Thank you, Ravi. Jai Jinendra, and good evening to you all, and good morning to few of my friends who have joined from different time zones. It is indeed my pleasure to be the moderator of this esteemed panel of speakers who are the stalwarts in their respective fields. I want to thank you all for accepting my personal invite. We are pleased to conduct a webinar today on emerging new world order and opportunities for India. With that, I would like to thank you, JITO and JITO Professional Forum, for giving me this opportunity. Well, the world is changing so rapidly. During this time, it's important to listen to the extremely talented pool of experts who are here with us today from New York and Singapore. They will help us to understand how they interpret the impact of COVID-19 on the global economy, how they plan to make investment decisions, how they plan to decide on which countries to bet on and which sector to invest in. I'm sure that their perspective on the world economy and reshaping of businesses post-COVID-19 will help us understand the emerging trend in the post-COVID world. So before we proceed further, I would like to introduce my colleagues and friends from JITO fraternity. With me today are Mr. Ravi Jain, Mr. Ajay Bohra, Mr. Ashok Ajmera, and Mr. Paras Bothra, and they will be assisting me in today's session. I would like to thank them all for giving me the wholehearted support. Let's first start with the introduction of our panelists before we open up our interaction with them. So I would like to call upon my dynamic Secretary General of JITO Apex, Mr. Anil Jain, to introduce Mr. Peter Boodel.
Thanks, Sanjay. I think Peter Boodel doesn't need any introduction. He's a Managing Director of Indus Capital and Board Trustee of Tiger Foundation, New York. Peter graduated with a BA with cum laude from Princeton University in '93 and obtained an MBA from University of Chicago Booth School of Business in 2005. He currently serves on the board of Untitled Gardens Conservancy as treasurer and head of the finance committee. Boodel also worked in the office of CEO of Chicago Public School as a director of special initiative. Before starting Boodel and Company, he was partner and senior analyst at Eastern Advisors Capital Management, an Asia-dedicated hedge fund under the Tiger Management umbrella. Mr. Boodel was also the managing partner and portfolio manager of Boodel and Company Capital Management, where he managed an Asia-focused long-short equity fund from 2010 to 15. Currently, Peter Boodel is managing director of Indus Capital, an Asia-dedicated investment firm with offices in Tokyo, Hong Kong, Shanghai, London, San Francisco, and New York. He is a senior research analyst based in the New York office. We thank Mr. Peter Boodel to be part of this session today, and we welcome you in this session. Thank you.
Thank you, Anil. Now I request Mr. Ravi Jain to introduce Mr. Manraj Sekhon.
Yeah, thank you, Sanjay ji. The mutual fund industry deals in various asset classes. Therefore, they understand the pulse of the investment market better than anybody else. We have a big sort of the mutual fund industry present with us today. Please welcome Mr. Manraj Sekhon, CIO, Emerging Market Equity at Franklin Templeton Investment, Singapore. Mr. Manraj has won the Best Fund Manager Award from Professional Advisor UK. He was also ranked in both the citywide UK Top 100 Fund Managers. So now, thank you, Sanjay ji. Now, please request you to take it forward.
Thanks, Ravi. May I request Ashok Ajmera ji to please introduce Robert Peyreigne.
It's indeed my pleasure to introduce such a great personality in the financial markets, Robert Peyreigne graduated from the US Naval Academy in 1981 with a Bachelor's of Science degree in Management. He served in the US Navy from 1981 to 1988 as a naval aviator. In 1988, he joined Kidder Peabody as financial advisor. He later worked as USB, Penn Weber, and Merrill Lynch before moving to Morgan Stanley. He was in charge of 450 people in 4 branches in New York City and Westchester country who produced US $275 million and oversaw more than 40 billion of clients' assets. He is currently the global head of wealth management for Jeffries. With this, ladies and gentlemen, I have great pleasure in presenting before you Robert V. Peyreigne, the Managing Director, Global Head of Wealth Management, Jeffries LLC. Thank you very much.
Thank you, Ajmeraji. Can I request Ajay Bora to introduce my really close friend, Mr. Manny Singh?
It's an honor to introduce Mr. Manny Singh. He is the CEO of Kavi Asset Mgmt, which is a New York-based hedge fund in partnership with Blackstone Group. He has been granted 14, I repeat, 14 US and international patents on his name. He is a graduate of IIT Delhi, MS from Stanford University, and MBA from Wharton. Any student from anywhere in the world would dream to go into one of these, but he has all graduated from all 3, IIT, Stanford, and Wharton. To add to that, previously he has worked with Julian Robertson at Tiger Management and Eastern Advisors, a Tiger seeded Asia-focused long and short-term equity hedge fund. Welcome, Mr. Manny Singh.
So here I would like to request all the participants that any views from the panelists during today's sessions will be their personal opinion and that might differ from their corporate view. So for today's webinar, we will first have one common question to all the panelists. Then we will have a Q&A session where I'll ask them a couple of questions each. Post this, we'll take a question from the open forum. So as we all know, the pandemic we have witnessed in the last couple of months has had far-reaching implications for the world at large. It has significantly impacted the world economic productivity, employment, income levels, disrupted businesses, and has resulted in many more hardship, not only financially, but also as a health crisis. Now, with the lockdown unwindings, central bank unleashing liquidity, economic rebooting, and optimistic trials being conducted by vaccine candidates. So my first question to the esteemed panelists, and you all can take 5 to 6 minutes each to express your view. In the post-COVID world, things have changed considerably. How do you see the new world order and what new businesses opportunities are emerging? Also, how do you see the global market performing? Do you think the bottom is in place and a new bull market has already begun? Or do you still see a lot of uncertainty? What is your advice to Indian entrepreneurs and investors? So can I start first with Mr. Peter Boodel from Indus Capital, and can we have your view, sir?
Thank you so much for the kind introduction, and thank you for having me on this esteemed panel. Thank you, Sanjay Dangi.
Thank you, sir.
I remember clearly trying to download my email in Bombay in 1996 from the server in Hong Kong when I worked at Jardine Fleming on some of the first participation notes in India. I was using a modem and a long distance call to Hong Kong to get through. Seems like just yesterday, and the 35-minute call to Hong Kong for a few emails, I think cost me $90. How times have changed. So it is an honor to be speaking here today at the JITO Professional Forum. I actually studied Jainism in high school in religion class, and that is another story altogether. But let me say, I admired the religion then, and I'm honored to be a speaker today. We were asked to prepare a few remarks regarding the post-COVID world and investing opportunities as we look out longer term. I think when we consider the changes unrolling before us in the post-COVID world, we should beware of recency bias. The human toll from the disease has been immense, and even more so, the economic response to put shock absorbers in place while the economy is still moving in order to avoid a crash landing. Combine this policy response with the drastic changes in workflow and daily living arrangements caused by social distancing. My wife is sick of me at home, and I don't blame her. So both the disease and the response have had a very real human cost. But also let us not forget the human ability to adapt and note the old truth, necessity is the mother of invention. We have the globe's scientists in unison waging a well-funded battle against this new viral enemy. There are a number of treatment regimes arriving, including antivirals, monoclonal antibodies, inhaled nitric oxide, interleukin-5, convalescent plasma, to name a few. Even do-it-yourselfers are in the mix, with the most interesting remedy I have read about being the antibacterial pills hikers use to purify water when hiking in the woods, which one adds to their water if they have symptoms to raise the oxygenation to kill viruses. Then, of course, there are over 100 vaccines in process, so choose your poison, but the world's scientists are tracking this enemy very closely. I invest across, including China and Japan, and activity levels 5 months post initial lockdown in China show almost a full recovery on industrial activity. However, travel and other social activities remain subdued. That said, there are reports out this week that travel from China to Japan is fully booked for July, though on reduced capacity. And this is before a vaccine is in place. So I would remind how adaptive humans are when necessity presents itself. How do I see markets? I am bullish. Bull markets climb a wall of worry. We pay 20 times earnings right now for the S&P 500. For a 10-year US Treasury bond, we pay 120 times the coupon. And Treasury bonds coupons don't grow. So relative to yields from other assets, the S&P is demonstrably inexpensive. In addition, a number of leading businesses in the S&P run at negative cash conversion cycles, meaning suppliers and customers fund them to grow. These include Apple and Amazon. How often in the history of markets have trillion-dollar businesses not had to fund inventory to grow sales? And many of these large technology companies have benefited from COVID-induced demand. Amazon hiring 175,000 workers on short notice since March. And the companies I talk to in Asia believe some of this COVID-induced demand will not go away when the pandemic subsides. New habits may stay. So we pay 20 times earnings in US markets because we think earnings over the next 20 years will add up to pay us back for our initial investment. So what if this year and next year are lower than expected? There are still 18 years to go. And consensus earnings are expected to show acceleration of 20% over the next 2 years as we recover back to old earnings highs by 2022 or 2023 in the S&P. We can also look back at past cycles and crises, like the 100,000 dead in the United States from the bird flu in 1968, or the swine flu in 1976, or SARS in 2003, or even 9/11, especially the weakness in travel post that event. What we see from history is that in 2 to 3 years, things get back to some semblance of normality. And there is nothing today that I see that will make this pandemic any different. It's just that this one happened in the time of Twitter. And as usual, it turns out grandma was right. You shouldn't put your hands in your mouth, ever. Thinking through longer term cycles, Warren Buffett has remarked on the 17-year cycle that the Dow Jones has progressed through since the 1950s. Maggie Mahar, in her book Bull, also spoke about this effect, where in the 17-year period, we have had strong bull markets and then followed by 17-year periods of weak to flat markets. And instead of ending a bull market, I believe we are beginning a new cycle begun around 2018, which will be propelled by 80 million millennials in America coming into their prime earning years, while at the same time witnessing one of the largest wealth transfers in modern history, as the boomer generation dies off slowly over the next 20 years. It is rare in developed markets to offset the 65-year and older generation cohort with an even larger cohort with a median age of 29 years old. This group is entering their prime, and I believe the businesses around this cohort will come to power this market going forward. And I would note that India is one of the few markets in the world that resembles these rare demographics. Considering trade wars and post-pandemic flow of trade, I think the offshoring theme led by China will shift as the US realizes that China wants to play by its own rules. We are at the beginning of a Cold War, and China is as much to blame as President Trump. They have been offered membership in a trading organization since 2000, but have repeatedly refused to abide by the terms that the other members abide by. And Trump has taken a mercantilist approach, demanding better, being equivalent terms if China wishes to do business in the US, as companies in the US must endure in China. And like Nixon was praised for opening up China, I think history will look kindly on this chapter, where Trump called out the unfair rules of the economic state within China. We will see where we go from here, but I think investment will shift out of China and migrate around Asia. And so it is a historic opportunity for India, if they want to build their manufacturing sector, to capture this offshoring from China. I have additional views on the growing trade and Cold War between China and the US and the tectonic shifts that may ensue. I have comments about gold and Bitcoin as stores of value, and about oil and the upcoming changes in the transport and mobility industry, but I'll save those comments for Q&A and follow-up. In sum, I think the US market is not expensive. A demographic wave is coming, which is very positive. And in follow-up questions, I'd be happy to address the structural change coming from the US-China trade war, changes in the traditional stores of value and securitization being gold, Bitcoins, and tokens. In mobility, combustion self-drive moves to electric autonomous, and finally in sources of energy. I think oil is the new hay and wind and solar have arrived. So with that, I'll pass it on to the next panelist or to Q&A. Thanks, Sanjay.
Thank you so much for your such an insight view. And I'm so happy that you have said that you already studied the Jainism. Now, can I request Manraj sir, can we have your view, sir?
Sure. Good evening, everyone. And thank you, Sanjay. Thank you, everyone, for this opportunity. It's a real pleasure and honor to be here. I have a huge amount of respect and admiration for the Jain community. So it's a great pleasure to be here with you all today. I think Peter's done a very good job of covering a lot of ground already. So I'll try and address a few of the areas where I think there are pressing questions about trying to reconcile what's happening on the stock market and contrast that with what's happening in the economy. Clearly, the last few months have been extreme in terms of what's happened to the health of individuals around the world, what's happened to the economy, what's happened to the stock market. And really, when you look at the last couple of months of economic data, we've seen in the US, for example, some of the best economic data in terms of growth and employment in a very short space of time, in a matter of weeks, turn into some of the worst economic data. I think it's very important for us to separate what's happening in the health of the world with respect to the pandemic from what's happening to the economy, and separately what's happening to the stock market. Now, clearly, all of them are related, but it's very easy to assume that what's happening with respect to the pandemic will naturally lead to effect on the stock market, but clearly there are very different mechanics at play here. Now, in terms of the health of the world, clearly we're seeing the end of this wave of the COVID-19 situation. And whether you look at what's happening in the US, Europe, in Asia, the number of cases, the fatalities, all of those data points look a lot more healthy. There are certain pockets around the world. India is one of them. Brazil is another one where there's reason to be perhaps cautious, but generally the picture is looking very, very much more positive than what we saw as recently as a month ago. Turning to the economy now, the impact of coronavirus, I think, will have very profound, long-lasting effects on the global economy, and we're yet to see that play out. There are going to be portions of the economy that have been hollowed out, that are unlikely to come back because of the distress on balance sheets and the degree to which their business models have been challenged and are unlikely to sustain themselves in the future. And I think we have to be very careful about putting all of the global economy in one category, because there are many different degrees of movement, many degrees of recovery, and certainly some parts of the economy that are shut down and going to be shut down for a while. Now, turning to the stock market, as we all know, the stock market is a forward-looking mechanism. What we've been trying to do over the last few months when we look at the companies that are affected by coronavirus is really look at what the impact of the earnings in this year and the earnings in 2021 are on the long-term value of the business. Now, when you think about the long-term intrinsic value of any business, 1 or 2 years doesn't really make a huge amount of difference. And typically it results in about maybe 5, a bit more % of valuation destruction. So I think we need to put that in perspective. But what is clear is that the kind of scare we've seen in the last couple of months has been nothing like what we've seen before. And I think this has real impact on the way people think about portfolios and how they protect their portfolios. So what I will say is that whilst I am positive on markets generally, I think we should continue to brace ourselves for a very volatile ride. Now, there are a lot of distortions that are being caused by the amount of liquidity that's being pumped into the economy from central banks, from governments around the world. We've not seen anything like that before. Some of you would have seen just in the last couple of days, the governments in Europe are looking to spend something in the region of 1.3 trillion euros to support their economies and markets. That hasn't even begun yet. So I think that amount of liquidity is having an impact on the market, and that will continue. In the short term, I would say there are 2 or 3 things that are not being priced into markets that we should be wary of. One is a second wave. I'm not a medical expert. I don't pretend to be one, but I think we've all tried to study this very closely, and I think we cannot rule out the risk of a second wave of infections in many parts of the world. The second thing we need to be conscious of is the upcoming year end, whether it's autumn or winter in the Northern Hemisphere. And given the degree to which a lot of countries in the West found it difficult to handle this situation, I think we should be very careful about how they manage the winter. So I would say a second wave and a winter pandemic are not being priced into markets, and we need to be careful of that. Now, turning to the stock market very quickly, I think what we're seeing in the stock market is a very polarized, bifurcated picture. So if you look at the period post the global financial crisis, post 2007, 2008, you saw capital investment, manufacturing around the world suffer because there was very little in terms of demand growth, demand sustainability. It was really led by the consumer and services and technology, the recovery we saw over the last 10 years. So you saw a very polarized picture in terms of the economy. Some parts were doing well, a lot weren't. I think now in the post-COVID world, you are going to see an even more polarized and bifurcated economy. And in some sense, the future has been brought forward. So things that we were all expecting to happen in 2022 or 2025 or 2030 even have been brought forward because of the pandemic. So certain parts of the economy are doing very well because their business models are totally in keeping with the world we live in. And certain parts of the economy, and we all know what they are, whether it's retail, whether it's real estate, whether it's hospitality, leisure, transport, etc., are finding their business models heavily challenged. So the net result is you've seen huge value destruction in that section, and you've seen huge value uplift in the parts of the market that are doing well. The net result is that the overall market has gone up because the proportion of the market that's accounted for by the new economy is significantly larger, whether you're looking at Asia or you're looking at the US and other major markets. And that's the net result. So whilst the overall market may give us the impression that everything is okay, I think, and the same is true as in India, when you look underneath, you will see that actually the market's been quite efficient in ascribing much lower valuations to those companies and those sectors that are left behind, and much higher valuations to the other side of the market. And when you look at interest rates around the world, even in India, discount rates, whatever your required rate of return is, that's come down a long way. So when you have new economy businesses with very long duration value creation, long duration cash flows, because these are companies that are going to continue to build businesses and build value over a period of time. When you value those businesses with a lower discount rate, the uplift, as we all know, is significant. So I think it's very important to make that distinction in markets. And in my own view, I think the general trend of that will continue. But as we go through phases of normalization, so right now we're going through a phase of normalization where people are focused on everything getting back to normal. So the traditional businesses are doing well, but I think there will be a reality check over the course of the next few months and quarters where the new economy businesses will continue to do well. I share the concerns about the US and China. We can talk about that later on, but I'll leave my comments there for now. Thank you, Sanjay.
Thank you, Manraj, for such a wonderful view. And I think we, sitting at India, we can take a lot of call from this thought. Now, can I ask Manny Singh, can we have your view, please?
Hi, Sanjay, and thank you guys for having me. JITO is, I got introduced to it through Sanjay, and I really admire the work that you were doing and the contribution of the Jain community, of course, everybody knows about. I agree for most part with what Peter and Manraj just said, but I want to think about a riddle, if you will, as it relates to the economy and world markets. So as we all know, COVID has been a truly global phenomenon. It's a global pandemic. Almost every country in the world has been affected by it. And I would argue that the US has been worse affected than most. I mean, if you think about some of the numbers that came out post-COVID, we're talking about 20 to 25% unemployment. These are numbers we have not seen in many generations. 100,000 people dead, the highest mortality count in the world, and GDP contraction well into the double digits, I think, for at least 2 quarters. And yet, when you turn to the public markets, the S&P as of last night's close is only down, call it 4 or 5% for the year. Now, you compare that to a market like India, where, whether you look at Nifty or Sensex, they're down almost 20%. The rupee is down another 5%. And so in dollar terms, the Indian market is down 25%, when you can argue that, in fact, the US has been much harder hit by the pandemic itself, the health implications and the real economy implications of the pandemic. And so it is a bit of a riddle. It's a bit of a conundrum, right? I mean, why is an economy that seems to be disproportionately affected adversely, why are its markets sort of hanging in there when some other markets are not? And I think to really figure out what's going on here, I think there's 2 different things we have to consider. The first reason, or the first explanation, has to do with the nature of the government response in the US versus a place like India. So in the US, I think perhaps because we had learned our lesson from the 2008 financial crisis, it was an overwhelming bazooka of a response, where, as everybody knows, 13% of GDP, it was a package that was Congress, the Fed, and everybody came together. But the important thing about that is that stimulus was in the form of direct transfers, so helicopter money. And so in the US, every man and woman got a $1,200 check, every child got a $500 check. They added $600 a week to your unemployment benefits. It was a $350 billion so-called PPP program, which is essentially forbearance loans for small businesses. They give you a loan and then they forget about it. And so if you look at the effect of essentially handing out money to people, what the data is showing us now is that incomes were actually up between 5 and 10% in the last reported period, right? So people are unemployed, they're sitting at home, but they're making more money than they did when they were working a job. And then you combine that with the fact that you're stuck at home and you can't be spending on, restaurants and travels and things like that. And the credit card data shows us that, in fact, spending in other categories, things like home improvement and apparel, et cetera, spending has actually gone up. And so the US response was forceful, it was direct, and it was demand side. Now, if you look at the Indian response, in contrast to that, the Indian response has been much more structural, or let's say supply side reform, versus a one-shot demand boost, right? So the RBI came out and essentially offered credit guarantees for small and medium enterprises. They backstopped NBFC loans to some degree. The government has put in place measures for rural job creation. Already the RBI coming into the year had cut the repo rate by over 100 basis points. And so these are all changes that are much needed. And these are all changes that in some sense are more durable than just handing out money to people. But the transmission mechanism of these changes is much slower. They take a while to disseminate through the real economy. And so I think the Indian markets are reflecting the difference in the nature of the government response. The second difference, of course, between the US and India is that if you look at the S&P and how it's composed, 25% of the S&P is IT companies. These are, the so-called FANG or pharma stocks, Facebook and Amazon and Microsoft and Google. And another 20% roughly is healthcare. So about half the S&P is what I would consider new age defensives. These are, ironically, they used to be seen 10 years ago or 20 years ago as growth stocks. Now I think it's abundantly clear that a business like Google or a business like Amazon, they're really defensive businesses because it's very hard to compete with them and their moats are almost unsurmountable. And so the nature of the S&P has gone from being more growthy to more defensive. And the Sensex, on the other hand, or the Indian market, still has a pro-cyclical tilt to it because banks and financials, for example, are close to 35% of the Indian index, and they have a more pro-cyclical tilt. So what we know about the nature of risk and the nature of flows is that when the world markets start to reflate because central banks generate liquidity and that liquidity starts to find a home, is that it's like when you have a stack of cups and you're pouring water down them, it flows along the curve. So at first it flows into treasuries, and we've seen the US 10-year correct from 180, 190 basis points to call it 60 or 70 now. And then it goes into defensives, which are the kind of stocks that I talked about in the US market. And then it supports DMs. And then over time, it makes its way into the emerging markets as you go further out on the risk curve. And so I think if we are to see a continued improvement in the real economy in the West and the US markets, I think at some point emerging markets will have to participate, and India is better positioned than most. So that's just this idea of looking at the US and looking at what's happened in India, both on the markets and on the stimulus side. Now, very quickly in terms of the US markets and are they expensive, I agree with both the awesome speakers that went before me. I think that it used to be that 20 times PE was expensive for S&P, but one of the main things that I learned working for Julian is that valuation is not a determinant of direction. And so at a time when the 10-year is 70 basis points and a lot of sovereign yields all over the world are negative, why would you not pay 25 times for a market where you get a 4% earnings yield, plus those earnings grow 3 to 4% a year, plus equities intrinsically are inflation hedges. And so the US market is not expensive. I think there are issues that have come to the surface. I think there are risks. It's an election year in the US. At some point you can have a return of cases, et cetera, et cetera. So it's not going to be linear. It's not going to be free from volatility, but fundamentally, this is not like the U.S. market is turbocharged or overshot or anything like that. So I'll stop there and look forward to questions and Q&A.
Thank you, Manny. As always, your views are outstanding. Your knowledge, especially in India and US, will help us to make a very informative decision. Now, finally, can I ask Mr. Robert Peyreigne, sir? And if you want, you can take that with you. And can we have your view, please, sir?
Yeah, I mean, our views, right, are encapsulated more in what do we not know, right? And what we don't know, right, is what's going to happen with this virus. And that's leading to, we don't know how deep this economic recession is going to be. right? And I would just say that, you know, there's 40 million people here in the US that were working 90 days ago that are not currently working. Yes, some of them are getting more money than they were making. Some of them, you know, are getting an extra $600, but, you know, we don't know how long this is going to last. And the Fed doesn't have enough money to give people this kind of money forever, right? So we don't know the depth of this, you know, slowdown. We don't know how long it's going to take. We can guesstimate and estimate what's going to happen to S&P 500 earnings, but it's really a guess. And we really haven't completely understood all the solvency issues that are going to occur between you know, in the economy. Just thinking about the small coffee shop that's in Main Street, Ridgefield, Connecticut, that can't pay the rent. So now the landlord can't pay his taxes, and the landlord can't pay his mortgage. And how is that going to affect the banks? Like, we haven't really understood the complete ramifications of how that's going to go. So there's a lot of negatives there, right? What's the one positive? The one positive is the Fed. And it isn't just the Fed, it's the Fed and the EU basically coming in with money and propping everything up. You know, the Fed's balance sheet has surely shown everybody, you know, the power to, you know, to heal all wounds. When the markets were correcting in March, you know, the biggest problem, you know, I would say for me, and my advisors and the clients that we service, right, is what happened to the value of certain fixed income securities, okay? The triple B area of the market where there's been a lot of debt issuance. You know, there was literally like no bid. And there was no bid until the Fed came out and said, well, nope, there's going to be a bid. We're going to buy this, we're going to buy this, we're going to buy this, we're going to buy this. And all of a sudden you got a bid, right, under bonds. And again, it starts with they're buying treasuries, rates are coming down, you know, the spread versus treasuries, which is what everyone looks at, got real wide. That's come down. Okay, the next thing is now we start rotating risk asset wise. You take something out of the 2008 playbook, make rates zero, force people into risk assets, and you know we'll get people invested, right? But you know, the other thing is that you know they've used the word bazooka. They've also said that they're willing to step up and do more if the outlook deteriorates. So you know the Fed, right, is what's driving this. The Fed is driving where the 10-year is, where the Fed is driving where the 1 year, where the 1 year is, and again, it's forcing money kind of into risk assets. I mean, short-term interest rates have been cut to almost zero. You know, unless you're in the investment grade, you know, the lower investment grade or high yield space, you're really not getting much of a return. But what we have seen is the ability for companies like Boeing and Ford to come into the market here, right, and get deals done. Been very, very, very confidence boosting to the overall market. But when you look at all of this, it's all dependent on COVID, right? And everything in the U.S. right now, when you go through and you think and you look about it, is all about the vaccine. And I know there's a lot of naysayers out there with respect to we've never done this before, and it's too hard, and you know this is going to be rushed, and all there's been is failure before. But never before in the history of the world has this much computing power, this much energy, this much expertise, this much collaboration, in addition to a government backstop, been issued here. And, you know, Anthony Fauci is, you know, face of, you know, our government when it comes to this virus. I mean, you know, he's hopefully optimistic that this is aspirational and doable. So I think, you know, as we look at things, and again, you know, there were 5 companies picked. You know, you got Moderna, AstraZeneca, Pfizer, Johnson & Johnson, Merck. There's also 95 other players out there trying to come up with a vaccine. That's really what's driving this. And I can say, what's our market outlook for the next 3 to 12 months? Are we going to get a second wave? I mean, we're starting to see some of that data, you know, here in the U.S. We've got some civil unrest going on here in the US. It's causing a lot of people to be out and about together. We don't know what the impact of that is going to be. So I think what we're going to see over the next month is what's the news with COVID and it's spreading, what's going on with the vaccine. Is the consumer really going to keep spending, right? What's the Fed reaction going to be? How are we going to be dealing with this China thing and the idea of deglobalizing the supply chain? Oh, and by the way, we have an election, okay, which would tend to be very paralyzing, right? So I would say with the S&P at 3,100, maybe a little bit ahead of what's going on. I'm not going to doubt the innovation and ability of modern science and people to be very, innovative in solving problems. But we're certainly in a very unique place. Probably the easy money's been made. And, you're going to have to be very selective as to what you do kind of on a go-forward basis. And we're having and I've asked Ted Sarur, who I work with, to join me here because I thought it would be helpful, right, to understand, it's one thing to talk about this stuff, to an esteemed panel, like this, but clients at the end of the day are people with money on the other end of the phone, living through all of this. And the most interesting thing is Ted has been doing this for over 50 years, started at Merrill Lynch, was a key player at Bear Stearns. We now have him here at Jeffries in our wealth management division for, for about 9 months. And Ted, I think can give some perspective because, businesses are run by business people. When those people have, concerns, right, they kind of change behavior. And I think if we could get into a little bit of Q&A with Ted at some point, this would be very helpful for the group.
Oh, sure, Robert. When I'll take the next question, I'll put towards the Ted. So thank you so much for your valuable suggestions on the US market and what's happening on the COVID side. Manny, thank you so much. Without you, I think I would have not planned this. I called you. You said, let's a good idea. You and Steve was so nice to me. Then I called Manraj sir. Thank you so much for accepting, in such a one call you are available. And thanks Sukhraji Nahar, who got me introduced to Mr. Manraj sir. Thank you so much. Now Admiraj to you.
Okay, so it was a great session, friends. We on behalf of the JITO Professional Forum would like to thank everyone who are involved in this, especially our knowledge partner, the Institute of Chartered Accountants of India, Western India Regional Council, the Rotary International District 3141, and of course our speakers, Mr. Peter, Mr. Manraj, Mr. Manny, Mr. Robert, JITO Apex President Ganpat Chaudhary ji, and so many stalwarts of the JITO who are attending this program. We are overwhelmed with your attendance. And of course, all the members of JITO, ICAI, Rotary, and our invited guests. We are all thankful to you for making this program a great success. In fact, the response was so overwhelming that people have to go over the Facebook because Zoom was completely full to the capacity. So thank you, everyone. Thank you, special thank to Sanjay bhai for making it really a great show. And of course, I would like to thank Akash for making it possible for us to manage Zoom technically so very well. Thank you, Ravi, Ajay, all our committee members for giving the responsibility of being a convener of this great seminar. Thank you, everyone. Thank you.
Thank you so much. Thank you so much.
Thank you, Anilji. Anilji is there. Anilji, thank you.
Yeah, thanks a lot, Anilji.
Thank you.